EBIT, 800. Then EBIT minus I, then what? Then you have EBT, earnings before tax, the taxable income. So I calculation is what? I equals debt times interest rate. Debt times interest rate. So I is dollar, interest rate is percentage. So that is 500 times interest rate 8%, $40. So minus 40, then what? 760, and tax 40%. So 760 times 4. 204, right? Then you have what? 6, 8, 4, 5, 6. That is net income. So ROE is 456 over equity. Total asset is 2,000, so equity is total asset minus debt. 2,000 minus 500, 1,500. So that is 30.4%. Again, good news is that only 4 people missed. That's good. People are working hard toward the final exam. Okay, final exam is just next week. You have 1 week till the final exam. So that is the quiz. And today's, let's continue our discussion of capital structure. And today's material is very important, as you know, highly likely to be on the exam. That is what? Choosing the optimal capital structure. So this one is really good because we are actually getting just optimal capital structure using numbers. And to do that, we just assume that to make it simple, so all equity financed, currently, starting from all equity financed. Then expected EBIT 500,000 from expects 0 growth to make it just simple, right? So 100,000 shares outstanding, and we check all those RS, P0, T, B, RF, RM, right? That was last class. And then we have some debt table. So when 0% debt, all equity company, there is no debt. But if you have 20% debt, so WD is 20%, then cost of debt is 8%. More like a realistic scenario. More debt means what? Higher debt interest rate. That is what? Companies become more risky. So as you borrow more, higher interest rate. So it's very high because bankruptcy costs related. So now, currently 0 debt, then now you compare that with different levels of debt. So which debt level is the optimal level? So from 0 to 20%, or 0 to 30%, or 0 to 40%, 0 to 50%, or sometimes from 20% to 30% is all recapitalization. just change their capital, recapitalize. See, if they recapitalize, that would be issued to repurchase stock. So that means what? You borrow money to buy back stocks. That means that, you know, you can make recapitalization fast by borrowing money and buy back stock. Then what? That will replace equity, right? So that is how to recapitalize fast. Okay? That you borrow money and buy back shares. Then you change your capital structure, right? Then now we are going back to chapter 11, cost of capital. We didn't say Hamada's equation, but this one, this formula that we used in chapter 11, cost of capital, especially divisional cost of capital, right? This formula we're gonna use because MM theory implies that beta changes with leverage, right? That means what? More borrowing means the company become more risky, so beta should go up. And BU, as we just have already seen, BU is the beta of the firm when it has no debt. We call it unlevered beta. So BL is levered beta, levered one, unlevered beta. So we used it already, right? BU times 1 plus 1 minus T times D over S, or D over E, same thing. S means stock, E means equity, same thing. D over E, D over S, same thing. You can use it interchangeably. So D over E. I use D over S because the textbook is like that. But D over E is more general, equity, not just stock, right? So that is the formula. So we are going to use it, right? Then step by step, let's do just the case when debt ratio is 20%. Then what should be the cost of equity? Then it's like this. We use beta L is BU times 1 plus D, T times D over S. Then what? BU is 1.0. That is from here, right? This beta is BU. Why? Because first starting from all equity, so that is actually BU, unlevered beta. So BU times 1 plus 1 minus T, tax rate, 1 minus T. And D over S is simple, 20% debt, the remaining 80% is equity, so 20/80. Then if you do that, then you will get 1.15, right? BL is 1.15. Then use capital asset pricing model. So we are using this one again, okay? Like chapter 11, divisional cost of capital. We use this one. So you use BL here and RPM. What is RPM? We do that.
Is that the market risk premium?
Good answer. But it says that RP first, so risk premium on the market. So that is same as market risk premium. Same thing, right? So market risk premium or risk premium on the market. RPM is risk premium on the market. That is 6%. That is again given here, RPM 6%. I told you that RPM is RM minus RF. Okay. So be careful, okay? Common mistake in the exam is that they mistook RPM as RM. Totally different, right? RPM or that is same as market risk premium, but that is not market return. It's because in the exam, many people took market risk premium as RM, so they subtract RRF from MLP. That's wrong, right? Already MLP is what? RM minus RF, so that is MLP. So all you have to do is just plug in the number. So 6% is just there, okay? But if you, this 6% minus 6% is 0, right? Then that doesn't make sense. So be careful. So be careful to read the exam, whether I give you RPM or RM. If I give you RM, then you have, instead of RPM, you use RM minus RF, right? Be careful, okay? RM minus RF. But RPM is given pretty easy. Just plug in here, 6%. Then cost of equity, 12.9%. Then now this is applying the same methodology to all the other percentages. We did this one, right? 20% case, WD 20% case. Then you can apply that to 30%, 40%, 50%, and you can calculate those, you know, RS accordingly, right? So 20% is given as an example. Then what? You can set up this table easily for 30%, 40%, 50%, following this step, right? So 30% is 30% over 70, 40%, 40% over 80, something like that. Then now it's time to calculate WACC. WACC is, as you know, WD times 1 minus T times RD plus WE times RS. And this time, WD is pretty easy because we already said 20%, right? So 0.2 times 1 minus T times RD, 8%, right? RD 8%. Plus WD is 0.2, then WE is 1 minus 0.2 is 0.8 times RS. RS is from here, RS, 12.9%. So 12.9%. Then WACC is 11.28%. Then you repeat this for all capital structure just cases. 20, this is 20%, but you can make 30%, 40%, 50%. So to do that, you can set this table. We just did this one, 20%. And you apply same principle to 30%, 40%, 50%. And then you will see RD and RS. But the most important thing is WACC. So again, the stock price is highest when the WACC is lowest. Be careful, can be on the exam, there's multiple choice. Stock price is highest when the WACC is lowest. Stock price is highest when RS is lowest, wrong. When RD is lowest, wrong. The stock price is highest when the WACC is lowest. So the reason we do it for 20%, 30%, 40%, 50% is to see what happens to WACC. WACC is what? WACC is at 30%, this is the lowest. So we know that 30% debt and 70% equity is the optimal capital structure. See, so that's why this practice is very good, because we're actually getting what percentage of debt is optimal, right? In this case, 30%. Then now, very important thing is on how to calculate corporate value. And this is going back to chapter 10, valuation. That is what? Value is free cash flow times 1 plus G over WACC minus G. Do you remember that? You have to remember that to be prepared for the final exam. So free cash flow 1 times 1 plus G over WACC minus G, right? So this is when the growth is constant from time zero, right? Constant growth model. Payment times 1 plus G over I minus G, same thing. Growing perpetuity formula, growing perpetuity. So free cash flow is like a payment. So payment times 1 plus G over WACC minus G. But we assume no growth. So G is out. And this G is now 0. So it's like free cash flow over WACC. But free cash flow formula is actually, as you see, free cash flow is NOPAT from chapter 7, NOPAT minus change in operating capital, right? But no growth, right? No growth meaning what? There's no additional investment. So now we understand that free cash flow is just NOPAT. NOPAT is EBIT times 1 minus T. So EBIT is given 500,000 from first, like example, EBIT is 500,000. So 500,000 times 1 minus T, there's NOPAT. There is 300,000 divided by WACC. Usually it's WACC minus G, but G is 0, so just WACC. That is 2,659,574, and that is value of the company with 20% debt. So you can apply this method to all other just capital structure cases. Then at 20%, the lowest WACC, look at this. Lowest WACC means what? Highest value. 2724. And that makes sense because you divide NOPAT by WACC. So what? WACC is in the denominator. The lower WACC, the higher corporate value. So we know the 2724796. That is the value of the company, the highest value, 2724796. And this one is pretty close, right? So the capital structure can be just between 30% and 40%. It can be a range too. So that is this. Debt and equity for WD is 20. So we can separate the value of the company between debt and equity. Anyway, Now we know that this is total value of the company, right? That is 20% debt. Then that is 531,915. Then what? Equity is what? Value minus debt. Total value minus this is this. Or you can just do it by value times 0.8. Same thing, right? 0.8. 20% debt, 80% equities. So you can separate the amount of debt, the amount of equity. So that is how to just divide debt amount and equity amount. And then what? You can apply the same technique to all the other percentages. Then we can just divide. Of course, when there is no debt, that is zero. This total stock value is 2,500,000, right? 2,500,000. Then what? Then stock value, this one is smaller than this one, but what? Total value of company is bigger because of this one. You add this 2 is total value, right? Add this 2, total value. And the total value is highest when the capital structure is 30%. Okay, so this is just a very good exercise. You just do it one by one and check when the stock price is highest, at what percentage of that. So now let's think about wealth of shareholders. Value of the equity declines as more debt is issued, right? Because debt is issued to repurchase stock, right? But total wealth of shareholders is value of stock after the recap plus the cash received in repurchase. And this total goes up. And this is equal to corporate value on earlier slide. So that is now very, very important. Very, very important. I told you that in 304, stockholder wealth maximization and stock price maximization may be different. And this is the case, right? That is the equity, stockholders are equity holders, right? Equity value goes down, but total shareholder wealth goes up. Because what? Shareholder wealth is not only equity, but also money they get, cash they get when they repurchase stocks. So here we think about total wealth of original shareholders. Yeah, that may be more accurate. So total wealth of original shareholders, right? Then what? Then their wealth goes up because they get not only equity, but also what? The cash. Okay, cash by the company repurchase shares, then what? They pay cash to stockholders. The stockholders get cash, right? Plus the stocks they hold. So stockholders' wealth is now, if your company is 100% equity company, then what? Then your stockholders' wealth is what? Just equity value, total is 100% equity. But if you borrow money and repurchase shares, then shares goes down, so equity goes down. But the amount of cash that is paid to original shareholders is still there. Original stockholders still have that cash. So cash plus equity, that is total value. That is total wealth of shareholders, actually, total wealth. It's not then what? Company value actually stay the same. The company value is what? Debt plus equity. But equity value goes down because equity is now similar portion. But instead, all the shareholders get what? Cash. So shareholder wealth is maximized at 30%. See? Because shareholder wealth is like not only the stock value, but also debt. Add these two, that's shareholders' wealth. But equity value is now smaller, but shareholders' wealth is what? They have this one in cash at them. So that is total shareholder wealth. So we think about what happens to shareholders' wealth. And then now very important, stock price. Then what is the stock price? When 20% debt ratio. Then if company issues debt, then what? Then that will change its WACC, right? We already have seen WACC change, and that changes value. Then the firm then use that proceeds to repurchase stock. Then what? Then stock price changes after that is issued, but does not change during actual repurchase or arbitrage is possible. This means in finance, stock price adjust immediately upon the information. That's very, very important, information. So if new information hits the market, stock price adjusts immediately. That's the key, So the sequence of events is like that. The company announce recapitalization schedule. Then what? That's totally new information, right? Currently it's 100% equity, but they announced that they will change the capital structure from 0 debt to 20% debt, then what? That's totally new information, and that information hits the market, then what? Stock price change immediately. Stock price changes immediately. Then what? Then the transaction, okay, they repurchase stock using the new price. That means what? Stock price changes after that is issued, but more precisely after they announced the plan, okay? Then there's a new information. Then what? After that, there is no other information, so stock price stays the same, okay? That is, and if not, there is an arbitrage opportunity. That is what? The people can get extra profit by selling selling high price stock and buy low price asset, right? Buy low, sell high, right? That is possible. And we'll talk about this arbitrage process in chapter 16. So simply, arbitrage process is what? If price is not right, then what? People will just trade to exploit the profit opportunity, right? So price has to be right. If not, the market is not in equilibrium. So in equilibrium, price should be right. So, the price should reflect all the information. So when they announce recapitalization, That's a new information. The price adjusts immediately, and after that, the price will stay the same, unless other information hits the market. But we assume that there is no other information. So that is the sequence of events. Company announce, and then they use that to buy back stocks, and then what? The stock price stay the same. The change after the announcement and stay the same. And then let's calculate stock price. Stock price, when that ratio is 20%, then it's like the stock price after that is issued, but before stock is repurchased, reflects shareholder wealth. That's exactly what I said. That is what. S is value of stock, and there is also cash paid in repurchase. So original stockholders get not only stock, they keep their stock, but those who sold their stock to the company will get what? Cash. So both are shareholders' wealth, right? So stock plus cash. So now it's like this is for you to calculate stock price when recapitalization happens. So when WD is 20%, some notation, D0. D0 is debt before recapitalization. N0 is outstanding shares. So before recap. So that D0, that before recap, number of outstanding shares before recap. Then D minus D0 is what? Is equal to cash that will be used to repurchase stock, okay? So this one, be careful, this one is when you issue debt. So D0 is, D0 can be 0, right? When you start from all equity, right? When you start from all equity, D0 is 0, right? But if you recapitalize again from 20% to, let's say, 30%, then what? Then D0 is the amount of debt when you have 20%, right? But in this case, we are starting from all equity company when D0 is 0. So that this distinction is pretty much not necessary, but we need this when we solve more difficult one, that is recapitalizing from 20% or 10%. In other words, not from 0, right? Not from 0. So right now it may be a little bit hard to understand, but you will see what's going on later. Okay, so S is stock plus D minus D0 is wealth of stockholders after the debt is issued, but immediately before the repurchase. Okay, so that is wealth of stockholders, right? Because stock plus change in debt. Okay, stock plus change in debt. So then let's apply that to the case when capital from WD equals 0 to WD 20%, then what? As I said, D0 is 0, right? And D is new debt, there is what? 531,915. And S is stock, right? So we did already that. That is what? Total value of company times 0.2, then there's that total value of company minus this is stock. That's or total value of time, total value of company times 0.8 is this 0.8, 0.2. And then what? Original number of share is 100,000, right? That is what? When the company is all equity financed. Then what? Then price is 26.596. But this formula needed in this case. That is what? That is when you evaluate from 0 to some level, that level, you don't need this formula. All you have to do is just simply P is V over N0, right? Because 212,760,660 plus 531,915 is value of the company, this two. Because what? D0 is 0 anyway. So this way is faster. You don't have to do this way, okay? But we need this way when you start from non-zero that percentage to another higher that percentage, then you have to use this way. That's why we have to know this, okay? But from 0 to some that percent, and just total value time over N0, right? That is this. Like this, 20%, not this one. Corporate value, like this one. 20% corporate value is this, right? Total value, corporate value, right? Then this one divided by 100,000, then what? 26.59 or 26.60, right? 5 cents roundings. So that is easier way from zero to any level, right? Total corporate value divided by original number of shares. That is 26.59. So 26.596, right? So that is just what's going on, okay? We use this formula, but since D0 is 0, it's just S plus D. S plus D is what? Total value, right? So you don't have to use this formula. Then what? Then number of shares repurchased. Yep.
Where did you get the 100,000 from?
That's a good question. 100,000 is from original data. Yeah, 100,000 shares outstanding, right? So that is given. That is given. Yeah. Good question. Thank you for asking.
Professor,
yeah.
Is there a reason why you rounded up the stock value?
Oh, actually, this one should be 26.60. Okay, rounding up like this. Dollars
oh no, I'm talking about the 2 million number above it.
This one?
Yeah.
That one is 212,760. That is, where is it? 212,760. Let's check. 21. Oh, 659. You're correct.
Okay, it's just like one.
Yeah, that's good. Yeah, good. You can be a good financial manager. Yeah, that's a discrepancy. Yeah, I agree. Yeah, there's no way. So that is just because of this, because of that's because like 2659574 times 0.2 is probably this one is already round down or whatever, or round up, right? That's why, so it should be, and more generally can be 914 or 4.7 or something, but this one can be 4.3, something like that. Then what? Then it can be 660. But those are roundings. Yeah, thank you for asking. Yeah. Thank you for just pointing that out. Yeah, there's no reason. There's just some kind of rounding problem. Yeah, bingo. Good question. Then a number of shares we purchased, that is the debt issued, right? Debt issued divide by price. I told you that the price won't change, right? Price won't change. Then what? Then 20,000 shares. And that is actually 20% of 100,000, right? Because it's 20% of total value. That weight is 20%. So you can do this way or even just 20% of total shares, 20,000. The remaining number of shares is like equity value divided by stock price, 80,000, or just 80% of 100,000. So you can check those numbers, yeah, because it should be 20,000 and 80,000. And if you just calculate some made a mistake, then it should not be 20,000. Then what? You know your stock price or that those ones are wrong, right? So bottom line is that it is 20% that ratio, so 20% of total shares, 20,000. This one has to be the final answer. So if you, and it's exact science, so whether you do this way or the 80% of 100,000, the answer has to be 80,000 shares. Then now we can apply that procedure to all the other percentages. Then what? Then know that 100,000 shares at 20%, 20,000 shares, 80,000 shares. 30%, 30,000, 70. So pretty obvious, right? And stock price is 27.25, the highest, price. And then WD 30% debt ratio gives highest corporate value, and look at this, lowest WACC, and highest stock price per share. But WD 40% is pretty close. So optimal range is pretty flat. So it may not be point estimate, but it's kind of range, right? 30%, between 30 and 40%, something like that. So that is how to calculate optimal capital structure. But when you recapitalize first 0 to 20%, and then 20% to 30%, then that's a little bit tricky. It's like this. So from 20% to 30%, then you have to make sure that at 30%, value is 2724796, right? From previous slide, right? 30%. Yeah, this one, 30%, 2724796. And then what? And then that is 30% that, so 30% of value. Then what? Then there is 817,438.8. And this one minus this is 190,735.72. In that case, you need this formula because D0 is not 0. So you have to have this S plus the difference between 30% debt and 20% debt, that amount, right? And then important thing is N0, because this is number of shares at 20% debt. Because it's starting from 20%, that is N0 is starting from 20% to 30%. So D0 is 20% debt. How much debt do you have? And 20%. And D is 30% debt, 30%. So if you divide that by 80,000, then you will get 2,741 compared to 2,725. Then what? Then what? 41 minus 25 is 16 cents different, right? Do you think is that a rounding error, or why do you think the price is higher when you, instead of just recapitalizing from 0 to 30%, you first recapitalize to 0 to 20% and then to 30%. Your stock price is higher. The reason is, if you just recapitalize from 0 to 30%, you have to buy stocks at this price, 27.25, right? But if you start from 20 to 30, then what? From 0 to 20, you are able to buy, what is it? The stock price yeah, this one, 2660, right? 2660, here you go, price. So the company was able to buy stocks at lower price, that is what? Almost to not almost, maybe 65 cents less per share. That's a lot, right? That's why if you recapitalize from 20 to 30, your stock price is higher than from 0 to 30 directly. And the problem is what? That is unethical, right? Because those who tender means what? Who sold their shares to company when they first recapitalized, they got only $26.60. But now from 20 to 30, those who tender their shares get 27.41. So what? Almost 80, more than 80 cents, almost $1. So in that case, all the shareholders may sue the company, right? So this is unethical, right? So the company, even though they can get more higher price by from 20 to 30%, they should not do that, okay? That's an unethical thing. They should go, if 30% is optimal, they should go to optimal capital structure directly from 0 to 30% rather than 0 to 20%, then 20 to 30%, then there can be lawsuit. So, but that was not intentional. You didn't know optimal capital structure, whatever. And then what? Then that is not unethical because they didn't know. But if they knew it and did intentionally, then that's unethical. So we have to be ethical managers. So you have to do from 0 to 30%. So, yeah, question.
I have a question. Where did we get 1,907,357.2? How did we get that?
Oh, that is this value starting from value at 30% debt, right? Then this is the optimal value, right? But 30% is what? Debt, right? So value minus debt is what? Equity, yeah. Or you can get this one by 0.7 times value. That is 30%. So equity is 7%, right? So that's please ask questions. Yeah, this is very important. This is on the exam many ways. So we have to be careful to make sure that everything you know that. But it's not, with practice, it should not be difficult. So at first, it looks like complicated, but if you practice a lot, then everything is what? Step by step, one by one. Just, and as I said, now you understand that you don't have to use this formula. You don't have to use this formula when you recapitalize from 0 to some level, right? All you have to do is total value divided by n, right? But you need this formula when you recapitalize from non-zero, so any percentage to higher one, then what? Then you have to use this one. Okay. So it's not that difficult. So that's the end of chapter 15. That is what? How to calculate optimal capital structure. That is very useful. I think that will be very useful for your management. So you can, of course, you have to gather all the information yourself, right? It's your company. But once those informations are given, then you can have some idea what is the optimal capital level. So you try to get the maximum benefit of that, not jeopardizing your, but just existence. That is not making your bankruptcy cost high. Right? So because those things are already incorporated in this data. That is what. That is this, right? That is, if you have more debt, then what? The debt cost goes up, okay? That those high interest rate represents higher bankruptcy cost. Yeah. So those things are already incorporated here, right? And this beta things incorporates equity risk. Okay, the more borrowing, the beta will be higher. The cost will be higher. The cost is what you use to discount. The higher cost means lower price. So you have to just adjust our balance, return and risk, profit and cost. So this is a good exercise.
Professor, can you go to slide 72?
So 72, let's go, 72. Yep.
For the 26.596, what is this considered? The number of repurchased, or what price is it? What is the P?
P is price of the stock when WD is 20%. And that is here. Not this one. No, not here. Price of stock. Here you go. Price of stock when you have 20% that level. And that is actually from here, slide 71. So price when WD is 20%, price is 26,596. Right.
And you said the stock price S will not change?
Yeah, when you repurchase, when you buy back your shares, the price stays the same. Because when they announce that they are gonna increase their debt ratio from 0 to 20%, then price will be this one. Because that is just because, as I said, price reflects new information. So when new information hits the market, the new information is what? They're gonna recapitalize, then price will adjust to this one immediately, and it will stay the same.
So what is the 2,127,660? That's also a stock price.
That is just equity portion.
The equity, okay.
Yeah, equity. So this is that portion. So this is total value times 0.2, 20% debt, right? This is total value times 0.8. Equity value, 80%, 20%.
Thank you.
Yep, thank you for asking. Yeah, that means you understand, you're following me. Of course, this one in the beginning kind of looks difficult, but with practice, it becomes easy, right? Because everything makes sense step by step. So you cannot get this answer directly, but step by step, like this, from the beginning, you use this, from this table, you use also Hamada's equation, and then you use the CAPM to calculate cost of equity. And then what? Then you use WACC, 20%, 80%. When you calculate WACC, then what? Then your corporate value is what? Free cash flow over WACC, free cash flow over WACC. So that is total company value. Then what? Then you divide that by number of shares. Then what? That is stock price. Then what? Then that amount is what? Total value times 0.2. Stock is value times D or total value times 0.8, either way. That's it, basically that's it. And then what? Then number of shares repurchased is D, total debt divided by stock price, 20,000 shares. Then remaining shares is what? Total stock price, total equity divided by stock price, or 20% of number of shares and 80% of number of shares. So just you just use it. So the highest price is what? Highest price is optimal capital. So this is optimal capital structure. Yep. And then what? And then finally, if you increase from 20%, 30%, what should be the stock price? Then you use this formula, So that's it. Okay, so that is the end of chapter 15. Stop share. So let me see oh, Jacob and Ahmad, you are not showing your face. There's a problem. You have to show me your face always. Okay. So that is the problem. Okay. Okay, thank you. Okay, let me then go back to share screen. So that is chapter 15 and capital structure 2. So it seems to me that today is, any question?
I got a question. What questions do you recommend we practice from the chapter 15 homework or chapter 15 problems for the exam?
Answer is everything, everything. You have to study everything, yeah. But as I said, the capital structure, exercise, that is very high, very high. Everything can be on the exam, right? But that problem is very over 90% to win the exam. So you have to, but that is actually actual number. You can get actual number when you do your just calculating your company's optimal capital structure. Then chapter 15 is overall, and 16 is more like a more detailed analysis of models and we see extension equity as an option. But it seems to me that as I review our progress, today is the second to last class, and we have not much time. So currently, maybe I may do until here, and we'll do cover dividends, because dividends is my area, okay? I have my own theory in dividend policy, many papers in dividend, just related, just phenomena. So I like to talk about dividends. So maybe we'll cover until then. And then you are not responsible for those ones. Then, but what? And then you are responsible for some dividend things. So that's my goal currently. Then, who are Modigliani and Miller? I already told you, right? So Modigliani was the professor, Miller was PhD student, but Miller was very bright. So they became just co-authors. So they published theoretical papers. They changed the way people thought about financial leverage. Not only financial leverage, but dividends or many corporate finance matters. So they won Nobel Prize. And MM's paper was published in 1958, long time ago. But I was there at that time, running and playing, whatever. In 1963, his second paper. And then after 14 years, Miller only published paper in 1977. And their difference is what? Their assumptions about taxes. So I already talked about that in chapter 15. Then now important thing is how they had some clear models, because they had many assumptions. So this is how to understand theories, okay? For any theories to work, they should have some assumptions. Then if you ask the assumptions, then how valid the theory is, right? First, firms can be grouped into homogeneous classes based on business risk. Homogeneous is simply same, okay? Like scholarly word, homogeneous, but same class. That means what? All the firms are what? Same risk class, same risk. Definitely that's not true, right? That is just not real life. And next, look at this next assumption. Investors have identical expectations about firms' future earnings. That's also not true, right? If that's the case, then there should be no trading. Everybody have same information. Who want to buy, who want to sell? Okay, they buy because that they think is like undervalued. They sell because this is overvalued, something like that. So in other words, they have different information or opinion. That's why they trade. But they say identical expectations. That's definitely wrong, not correct. There are no transaction costs. That's also definitely not correct. Real life, you have to just pay like fees.
Professor, why do people study them if these things are incorrect? Or why did people listen to them?
That is, as I said, that is, they need those assumptions to have clean outcome, right? Then what? Then, you know why they got Nobel Prize even with those unrealistic assumptions? Because they are the first who analyze those capital structure problem using some very rigorous and theoretical approach. And this is the price. So they simplify the world to get some clean outcome, but without those simplification, the clean outcome is impossible, because what? Real life is very sophisticated. You cannot explain real life with just one, equation or something, one theory. Okay, so that's why, yeah. So, and another benefit is, then after this paper, then people just kind of analyze. Then if we allow the homogeneous, rather than homogeneous, the opposite is heterogeneous, then what? Then what happens? Or if they have different expectations, what happens, right? If there is transaction cost, what happens? And then what? Later papers examine those ones. Yeah. So they set the stage of further research. That's why. Yeah. And they also said all that is riskless. Again, that is not real life. How come that is riskless, right? The company issued that, then that's risky. And look at this, both individuals and corporations can borrow unlimited amounts of money at the risk-free rate. Wrong, that's definitely wrong, right? But they use those assumptions, strong assumptions, to get clean-cut result. And all cash flows are perpetuities. That's also wrong. Okay, cash flows are fluctuating, right? Perpetuity means what? Same cash flow, same net income forever. So that is also not realistic. So, and also they implement perpetual debt is issued. Firms have zero growth, and that's also not realistic. Usually company growth. And expected EBIT is constant over time. So that's also not true, right? Since we'll skip like some growth case, right? Remarkably, when they include growth, the details changes, but the intuition didn't change. So that is some remarkable things, right? So, you know, it depends on how important the assumption is, or how relevant in real life. So you can just have a grain of salt when you evaluate their conclusion, right? That's important. And besides, MM's first paper assumed zero taxes. That doesn't make sense. That's totally against real life, right? How can you avoid tax? That's why people criticize that, so they add taxes. And no agency or financial distress costs, right? So they didn't think about agency problem, financial distress problem. So that's why that is just good for them. Okay, so you'll see what the pros and cons of their paper. So their paper, I think, the conclusion is not very good. Okay, but why they got Nobel Prize? Because they provided us how to evaluate or how to do research, some research framework. They provide some research framework. That's why they got Nobel Prize. So these assumptions were necessary for MM to prove their propositions on the basis of investor arbitrage. So I'll talk about this one using examples. So MM with zero taxes. First proposition is VL is VU. That is, whether they borrow money or not, doesn't matter. They have same value. Then proposition 2, cost of equity of, see there's SRS, cost of equity, L means what? Levered company, is cost of equity of unlevered company plus risk premium. And risk premium is RSU minus RD. RD is cost of debt times the DORS. So that's their proposition. Then we can have some examples. So they are in the same risk class, that's the assumption. Let's say EBIT is the same, 500,000. Everything else has to be the same except what? Capital structure, right? And Form U has no debt, so I'll ask you 40%, let's say, that is given, no debt. Form L has 1 million debt, and RD is 8%. And basic MM assumptions hold. There are no corporate or personal taxes. Oops. The battery is running low. So let me make sure that there is the battery. Okay, so there is battery. Okay, So, and then GU is
Professor?
EBIT. Any question?
Yeah, could you just go back one slide, please?
Not sure. Yep.
Thank you.
Okay. Next. So VU is EBIT or RSU because what? VU is, according to practice we did, free cash flow over WACC, right? Free cash flow over WACC. And free cash flow is what? EBIT times O minus T minus change in operating capital. But we assume no growth, G is 0, and no tax. So that's why EBIT, there is no EBIT times O minus T because no tax, assumption is no tax. So just EBIT over RSU. So 500,000 over 0.14 and 3571 for 29. And VL is VU, so 3571 for 29. Then, now, VL, they have $1 million debt. So total value is debt plus equity. So S is debt, total value minus debt, 2571 for 29, right? So then what? And they prove this. They prove this using arbitrage argument. So this is very important. This is, how to prove in economics or financial economics. So how to prove your proposition? That is what? Using no arbitrage profit approach. This is very important. So to prove that, you first say that if the value of level firm is 4 million, let's say, they say that value of level company is same as value of unlevered company, the 3.57 million, right? But to prove that the value of levered company is 357.49, to prove that, they say that if the value of levered company is 4 million, right? Then you just the arbitrage, no arbitrage proof is such that 4 million is higher than what? Higher than right price, 3.571 million. So basically the approach is buy low, sell high. So you sell levered company's stock and buy low, that is what? Unlevered company stock. And then there is a difference, then what? Then that is arbitrage profit. Arbitrage profit means what? No risk profit. What would you do? If you have a no risk profit, what would you do? You try to take it, right? You try to take it. So everybody want to try to take that no arbitrage profit. Then what? Then the demand for low price asset will increase. So low price asset will go up. And wait. Yeah. So, and people try to sell high price assets. The demand for high price asset goes down, so high price asset price goes down, so they'll have equilibrium price. That is the total picture. So let's see. The status quo means what? The current state. Suppose you owned 10% of Form L's equity. So that is 10% of Form L's equity. So Form L is what? We assume that 4 million. So 4 million minus 1 million is debt. So 3 million is equity of Form L. Then you own 10%, so 0.1 is what? 0.3 million. So you have $0.3 million in your pocket. And not yet, you haven't sold it, status quo, so you have 0.3 million worth in the company. Then your cash flow is equal to 10% of the dividend paid by the leverage form, because you will own 10% of the company, right? So because it is a zero growth form, its dividends are equal to its net income. That means what? 100% payout ratio. So it's just 100% payout ratio. For you to grow, you have to retain some money and reinvest, right? But it's no additional investment. Just you maintaining the current, level of income. So you pay all net income as dividend. So net income is nothing more than EBIT minus D. And D is what? D is EBIT minus I, right? Interest. Interest is what? Debt times interest rate, always, right? So 500,000 EBIT minus 1 million debt times interest rate, then you have 420,000. That is dividend, right? So your 10% share is 420,000 dividend. 10% of that is yours because you have 10% owner. So currently, your annual cash flow is 42,000. That is status quo. That is what. Currently, since you own 10% of the company, you can get 10% of the dividend. And dividend is nothing more than net income, because of total net income is paid out as dividend, 100% payout ratio, no growth. So actually, net income is EBT, earnings before tax. Why? Tax is zero, so no tax. So EBT is net income. So that is actually net income. EBIT minus I, that is net income. That's status quo. Then what? Then arbitrage process is like that. As I said, the stock L is overvalued, so you sell overvalued stock. Then what? Then you will get 0.3 million, right? That's your portion. Because, as I said, 3 million is equity, because 4 million total value minus 1 million debt, and you have 10%, then 0.3 million. Then you use this money and borrowing an amount at 8% equal to 10% of Firm L's debt. And here comes the assumption. The main assumption is this: what the company can do, investors can do the same. In other words, if company borrow money, then investors can borrow money at the same term. And that's not true in real life, by the way. And it's not risk-free rate, right? And there is transaction cost and so on. But if we ignore all those things, then what? What the company can do, the investors can do the same. That's their argument. If investors can do what companies can do, then what? There's no advantage of borrowing money. Investors can borrow money too, right? That's their whole just argument. So here, you sell your stock and borrow money at 10%, same as the company, just and same as their original share, 10% from STAT. So from LSTAT is what, 1 million, and they just borrow same proportion, 10%, okay? Because they have 10% share of the company. So even that, they want to borrow 10% of that. So then what? 0.1 million. So then your total money is 0.3 million from sale and 0.1 million from borrowing. In total, 0.4 million. Then you could spend 0.357 million to buy 10% from used stock. So buy low, sell high. So you sell high price stock L and buy low price stock that is what, from L, from U, was same as before, 10%. So from U is 3.57, right? As I said here, the right price is 3.57, right? So, and 10% of that is 0.3571. Then what? Then you have total 0.4 million, right? So 0.4 minus 0.357, then what? The remaining 43,000, right? That is, you invest in risk-free debt. So this 43,000 is 0.4 million minus 0.357 million. Then what? That is 0.043 million. That is 43,000, right? Oops, no more fun, 429. So you have 4:30, you have 9 minutes to do this quiz. Stop share. Somebody, is there a quiz today? Yeah, quiz.